Okay, what's up? What's up? What's up? Hey, everybody. Hey, Steve. Do
Hi,
I have a
Kristin.
treat for you guys today? So my name is Kristin Gutierrez, and welcome to my podcast. I'm really excited to be joined by one of my new friends, Steve Hageman, and I'm going to let him tell you all about what he does. But it's just so fun to talk to people like Steve because he's super knowledgeable and really funny as it relates to like how he helps people with the services that he offers. So, Steve, welcome to the show. Tell us a little bit about you.
Well, thank you, Kristin. Thank you for inviting me to your show. And I've been working in mortgage lending for about 25 years. 25 years, been doing it more than a
What?
bit. And loving Long Beach. Most of my career, I've been serving in the city of Long Beach.
No
I have an
way.
office in Long Beach on PCH near the traffic circle and been doing it, now I've been living in Long Beach now for about 12 years. So I live and work in Long Beach.
Oh my gosh. What's up? That's so fun. You are literally right by my house. Okay.
Oh, yeah?
Yeah. Yeah. I always say I'm right by the traffic circle. Okay. So that's cool. So 25 years. So basically, right out of high school, you started doing loans.
Yeah. Middle school, yeah, it's something like that. Something like that. A little detour. I worked in city management for 7 years before I got into lending. So I apply
Wow.
that a lot when I do like fixer loans and things like that. Know the ins and outs of building departments to help my clients buy fixer loans or fix the homes they have.
Okay, so that's why I love talking to somebody like you because you have your hands in many different types of loans. Is there like a number that you know? Is it like or over X? Like how many loan types do you?
Oh, Lord. I don't know. I mean, technically, there's like probably 40, 50 types of loans. And, you know, I compare it to like, yeah, and a lot of lenders have a lot of these different loans, but I compare it to like a musician. Some people
Mm.
know how to make music with the instrument, some people know how to make noise, and we try to make music with these programs and apply the right programs to the right people in the right situations to help them achieve their goals.
Yeah. So maybe that is what differentiates you or your firm from others is like it's not just a one size fits all cookie cutter type loan. It really is what's the right loan, what's the best fit for the client and their situation.
That's right. It's loanmatch.com here.
That's clever. Okay, and the other thing that I like really like I put in quotes like about you is that you're somebody I see out there who's continuously educating people in the whole real estate industry, right? Both direct clients as along with us realtors and everybody else in the orbit or in the atmosphere, the real estate atmosphere on the loan programs that you offer. So you do webinars and you do online trainings. And I know I've said it to you, but like that is just not something I come across a lot. And I think it's such a killer vehicle for both educating people on what's happening and increasing know, like, and trust of you as a loan officer. How
Well,
long have you been doing those? Yeah, go ahead.
oh gosh, I started with doing seminars at the Grand Event Center in Long Beach probably 15 years ago with Cal HFA. And they
No
would
way.
speak at the events that I would host and sponsor. And yeah, I probably started doing it then because people don't really, show up at my door and say, "Hey, I'd like a renovation loan with 2 scoops of ADU." It's like nobody really knows what they need program wise. And that's why I think education's important because, we all know people's situations. Like maybe they need multi generations to afford to buy a home nowadays because of how expensive things are. And they may not realize that ADUs and things like that can help make multi generational home ownership possible. And it starts with education. It doesn't start with them asking for that program and for that solution. They just know their desires and goals. And the education leads them toward, having the confidence to pursue their goals because we identified certain paths that help them.
Yeah. Okay, so let's talk about some of those examples. I mean, I know the first time I got all jazzed up about what you do and the company that you work with is was the one on condo HOAs. And that's a great example of a program, or I don't know from what angle you were coming at from it. So why don't you tell us, add my
Yeah.
color?
Yeah.
Okay.
Is it a program? No, it's really
Yeah.
about there are a lot of obstacles, if you will, in condo financing because there's been for the last several years. In fact, it probably started, I would say, in 2021. There was a tragedy in Florida
Right, I
that
remember that.
had a condominium building, multiple story collapse,
Mm,
and a lot of human tragedy and a lot of destruction of value and the destruction of and the confidence in lending on condos. And it was kind of a wake up call for lenders. And Fannie Mae is kind of a clearinghouse for most lending. And it was a wake up call to Fannie Mae to say, hey, we better be making sure HOAs are inspecting their properties, making sure the buildings are in structural integrity and things
mhm,
like that. And when you combine, so that has domino effect into a lot of inspection requirements, both nationally and in the state of California. There was another tragedy in Berkeley a couple of 3 years ago with some Cal Berkeley students on a balcony celebrating a
right.
birthday, and the balcony collapsed, and there
Mhm.
multiple fatalities. Very sad story again. So California has imposed balcony retrofit and inspection requirements, and all across the state and
Oh,
everybody's moving to their own drummer time wise on implementing those guidelines. And then when you add, a lot of our insurance issues in California with insurance restrictions, if you will, with California on how much you could charge, and some insurance companies, let's say like State Farm, saying, tap out, I'm out. It's put insurance and building issues have put a lot of difficulties with financing condos. So, am I using a unique secret loan program? No. What I am using is a unique, strong condo department that is really digging in, finding all the details. And if there's hair on it, we shave it. We don't just run away. I mean, there's a lot of banks and brokers that just run from condo financing. And I've made it kind of in a specialty or priority, I guess is a better word, to help people trying to buy condos, which are important to buy
yeah,
because of how difficult it is to afford a home in Southern California. So
right.
we lean in hard on condo financing. I've got a lot of listing agents that have my phone number to tell buyers and buyer agents to say, hey, if you want to succeed in buying this condo, talk to the condo king, Steve.
Love it, the condo king. Well, and not only
Yeah.
that, but it's like if you wanna sell your condo, talk to Steve. And and so here's the thing is that's a great example to have started with because it might not be a specific loan program like you say, but
Hmm.
from a realtor's perspective and as a consumer of somebody who has bought and sold a couple condos at least personally, right?
Hmm.
Uh, I know the intricacies and the ins and outs of, oh my gosh, like my HOA that has literally 0 money and the building is falling apart and we need to special assess, not a few $100 or a few $1,000, but $20,000 plus per unit, and it's still not going to fix X, Y, or Z problem. So you come in and you educate us with like a simple 1 hour webinar training, whatever you want to call it, and now all of a sudden, our know, like, and trust with you is going through the roof. So maybe I need to buy a condo, or maybe I'm a realtor who has a client, or maybe not, but maybe I think of you first now for the next loan. And that
Hmm.
is what's so beautiful about people like you and me who put content out there, even like the podcast. It's like now they should go and how do they how does somebody get on your email list to find out? Because I attend a local event with you where I hear a lot of things, but how does like a general do they follow your social media? I'm genuinely curious.
Well, yeah, I guess social media is part of it. Also, I do a lot of these events through Eventbrite, and
Oh,
I have about 150 followers of what's he going to post next. They get like the first preview of what I'm up to next.
yeah.
So that's one way on Eventbrite. It's under the guise of the Long Beach Affiliates, which is an association that I coordinate as well. So that's
Okay,
the name.
cool.
The moniker name in Eventbrite is Long Beach Affiliates to kind of follow, since you
We'll put
asked.
it in the show notes, actually,
Yeah.
so you'll
Okay.
text it to me after.
Okay. Yeah.
Yeah, because it's super important. I do that with my sourdough bread. I sell bread, and there's another platform I use, and if they subscribe to the platform, they know when I do a bread drop. Otherwise, I'm just, like, posting about my bread. I'm like, $5 a loaf, and then the way I figured it, my cell phone number is all over everything anyway, so I'm like, DM or just, like, text me, and here's my number to buy some bread. So yeah, it's good that people know how to find you, basically,
Mhm.
and
Yeah.
kind of
Yeah. I and then it's a network of people that have attended or RSVP'd seminars, both consumers and realtors. That's about 3,500 people between consumers and realtors over the last decade and a half that
Whoa.
have attended or at least RSVP'd for one of my events. So I let them know that way through video emails.
Nice. Okay, cool. So you did the condo thing. That's how I first kind of got into your training orbit. And then recently you did another webinar training. So tell us a little bit about that one because I wasn't there. So I am curious, was that another purely educational topic or was it here's education around a specific type of loan?
Well, I always like to educate and empower. I my education is to help people achieve their goals. So the thing about this last event was about fixer loans. Sometimes I call them HGTV loans because that's how in 30 minutes these people buy a fixer home, and get with little money, they get it, all cleaned up and everybody cries of joy at the end of the episode. So in any event, but what the market niche that's happening right now is that fixers have become a buyer friendly market. They've been
Mm,
on they typically are on the market more days, like over 30 days on the market on average. And flippers, first of all, flippers used to buy these like hotcakes, right?
right.
And, a lot of flippers are on the sidelines right now. And the few flippers that are, trying to do something are very much lowballing these fixer listings. And the
Mhm,
sellers, unless they're in desperate straits, are saying no thanks. So they
mhm,
would love it if they could just get somebody to give them a reasonable offer. So that's the seller. The buyer, on the other hand, realizes, hey, those are good deals, but I only have 3.5% down. I don't have money to spend 50 or $75,000 to fix up a fixer.
mhm.
So the education of the program is we could finance the 50 to $75,000 or more that it costs to fix up that fixer. And we put it into the loan. We close the sale as is. That's why you see listings sometimes that say cash only.
Mm.
That's a cardinal sin for a realtor, by the way, because really they should be saying pre-approved for fixer finance. And
So
real reason why they're saying it is they think an appraiser is going to say, "Oh, you've got to fix this and fix that," and they're going, well, if we had the money to fix it, this is speaking from the seller, we would have, and we would
mm,
have gotten a top dollar. So these fixer loans can close the sale as long as at a minimum, the issues on the property that an appraiser calls out are part of the scope of work. So as
oh,
long as the hole in the roof, a hole in the floor, a hole in the wall, the sprinkling sprinklers, whatever. I mean, that shouldn't be sprinklers; they're just pipes. That those things are part of the scope of work from the contractor. Then we
mhm.
close at the plumbing, all the drama as is. So we close
Oh
as
my
is. We're the cash buyer. So that's an educational thing. Most lenders don't offer it or don't promote it.
Right, educating
And
around it. Okay, I have questions, Steve. Okay, so what's the sequence of events for okay, so a realtor lists a home that at the end of the day, somebody wants to buy and fix. Let's just leave it at
right.
that, right?
Mhm,
Okay, so then the sequence of events is the buyer writes an offer, the
mhm,
appraisal happens, and then once the appraisal comes back, the buyer works with, it sounds like a contractor to get an estimate?
Well, there's 2 ways to do that. It's like the good question is the chicken or the egg, the contractor or the appraiser, who comes first?
Mm,
Most in sometimes we have accidental rent fixer loans, and the accidental is the appraiser comes first, bah, bah, bad news, and then off to the rescue is the renovation loan with the contractor. But if we
yeah,
know with our eyes open that it is going to be a fixer situation, we start with the contractor.
good.
Because
Okay.
imagine we don't know how much it's going to cost to fix everything. And we don't need to limit our work to fix. We can
Mm,
upgrade, we could remodel, we could take it from the Brady Bunch to 2026, or whatever. Or maybe there's not enough bedrooms or bathrooms. The scope of work can include adding bedrooms and bathrooms. So we just don't know the cost of the scope of work
mhm,
until we get a contractor estimate. So if we're hunting for fixers, we really that consumer really wants to have and realtor wants to have a contractor on standby to give some decent early estimates because their borrowing power. So let's say I'm saying you're qualified for $900,000 for fixer financing. And that's the combined amount of fixing and buying. So if the property's $800,000, then you're up to
mhm.
$100,000 to renovation. So we can't just defer how much it's going to cost to fix. We need to know right up front to kind of pre-approve them for the amount of money they'll need to borrow to end up with a home that they'll like. And
Yeah.
by the
Well, this
way, we could, by the way, and I'll finish with that part, is that we can even finance payments up to 12 months while the place is getting fixed. If there's a lot of sawdust, a lot of noise, a lot of craziness, depending on the scope and scale, they could stay in the home that they're renting or owning now until the new home is ready to go.
okay, it's too much. It's too much. I'm like, slow down because people hearing this for the first time, like they're stuck where I am. Like, hold on. So the cool thing is when clients use me to list or buy their property, I come with an in-house contractor, right? And so
Yep.
not everybody knows a really great contractor who can do a full gut renovation and or simply patch up a few accidental in-home sprinklers, i.e. pipes in the wall.
You know, so,
As
oops,
true as
we're not on fire.
so that's super cool. And then I love the chicken and egg analogy because, right, a buyer coming in to say, it's like there's a sliding scale of a fixer, right? At the end of the day, I think, especially in the neighborhoods like I work in, Los Altos, Park Estates, really hyper specific in 90815 Long Beach, right? But nonetheless, they might not be. I mean, certainly I have a friend who bought a fixer and then is building, I believe, a 2-story ADU in the back of the house. Are you still, Steve, you froze? Yeah. Okay.
What? Am
Okay.
I freezing? You
Yeah,
good?
we're good.
Okay.
Yeah. So,
I was intently listening.
yeah, so we have buyers like that. And then we have like a more traditional homeowner buyer who is like, okay, I'm willing to take a fixer upper because maybe I can quote unquote get it for a better deal, but then I don't know where all of the various pieces come in. So I really want to talk to that buyer right now because they might not be as savvy or knowledgeable as the buyer who's on the far end of the buying spectrum, who's like a total flipper, right?
He
It's
mhm,
it's like Jane and Jack and Jill who,
mhm.
yeah, they're a homeowner. They want to be a homeowner. They want to live in their house. Like whether maybe they're going to add on in the future, but like they really want to buy this home that does really need work. So that's why I was like, okay, let's talk about the 12-month thing in a second. But right now, what are some of the requirements? You said 900K, 800K, but like, are there ranges for what the loan can go
Yeah,
up to? Talk with us about
for
percentages.
the most part, and I don't wanna deviate too far with the jumbo options that we have for multi-million dollar homes, but generally speaking, in LA and Orange County, you could go up to $1.3 million in loan amount to buy and fix combined. And that's a 1 unit. The unit as if it's 2 units, it's, I believe, 1.6 and so on. It could be over $2 million with four-unit properties or making them into
Oh,
four-unit properties.
yeah, that's my question. So, like, it could be a it could be a one-unit home right now, but because Long Beach is Long Beach, I could want to turn my home into 3 units. So now it's not the 1.3 or whatever it's not the first level, it's actually the 3rd level,
Right.
right?
Yeah. It's how many
Wow.
units you end up with that sets the loan limits, not how you start, but how you finish.
And obviously you have to qualify for the loan. It's not like we're handing out candy, but
And then
this
we'll
is
count the rent income of the future unit's rent up to
yeah.
about 75%, depending on which program fits the
Let's put a
client.
pin in that because that's a very good point to bring up after we talk about the 12-month thing, right? Because it's all about, like, how you qualify. And
Uh-huh.
then what is, like, the percentages? Debt to income or, like
Well, the debt to income is all the same as regular loans. Usually, we don't want borrowers to get into more debt, the housing payment to be more than about 45 to 46% of their gross monthly income, uh,
right.
net monthly income if they're self employed. So, and then up to 50 or 55% when you combine housing plus maybe monthly payments on car loans, student loans, credit cards, and things like that. So we can
Okay.
allow for about a 10% on top of that for consumer debt, not expenses, but debt.
And then I guess that is where the rental income would play, so we'll talk about it real
Yeah,
quick because
because that adds toward that income.
I don't think a lot of people again, the person I'm talking to right now, I don't know if they know that. Like, I know when I talk to my friends, because we bought a duplex in Wrigley several years ago, and the whole duplex was being rented, and we owned a condo already. So I forget how the paperwork worked, but that's when I first learned because I lived through it myself that the rental income counted toward my income to lower or increase, however you say it, the DTI. So now tell us a little bit about how they factor the income on the rentals, long-term
Well,
rentals.
yeah, long-term rentals for the most part on these programs. And so we do, I mean, everything about the appraisal is based on looking at the contractor's offer or bid and projecting it or imagining it as though it's already done. So when the contractor's bid includes adding rental units,
Mm.
then they add the square footage of it, how many bedrooms, how many baths, and then they do a market rent survey. A part of the appraisal itself includes a market rent survey, and we'll take 75% of whatever that market rent survey says this future rental unit will generate or command in terms of monthly rents. And we count that toward the rental income, toward the overall income of the borrower as though the money's already there.
Oh my gosh. I just like, I hope we're blowing people's brains right now in the best possible way. Because that's the advantage of talking to somebody like Steve is really, like he said, it's like a best fit use case to what it is that you're looking at, what it is you're trying to do. And also as a realtor, if you're real estate agents, like listening to this podcast, it's understanding that unique loans like this exist so that when you get a listing that has a funky layout, I can think of one right now that I was doing an open house at, and I could see it instantly that the house could be divided into 2 with a 1 bed, 1 bath over there and a 2 bed, 1 bath over here, let alone if they added anything on. But, unfortunately, it's just like, who's the right buyer with the right can ideate the right concept with the right contractor, with the right loan officer to put the package together that makes sense so that when the appraisal comes back, like you were saying, the chicken and the egg, now we're not fighting against, the appraisal came in too low and we're trying to do X, Y, and Z. It's like, no, we are already going to do A through Z, and we're simply choosing a loan program that meets our needs.
Right. And sometimes we pick up extra projects along the way. Let's say somebody really wants a three-bedroom, two bath, and instead of, competing in that marketplace, offer on a two-bedroom, one bath, and then include adding the bedroom and bath. They're going to get that offer accepted more likely because there's less people shopping for that two-bedroom, one bath. So they're going to get right in there. So there's little tricks and toys you could do with these programs and to help people realize their dream of home ownership.
I love it. Okay. And so then, drum roll, like we'll start to wrap up here. But what was the 12-month thing? So tell us about that now that we have a better
Well,
understanding.
you're buying a fixer, but you can't live in a fixer until it's fixed sometimes, right? So it's like, the reality of that is known by the people the lenders that create these programs. And so we can finance as long as there's enough, they can afford financing the payments. We can finance while the property is being worked on and is not habitable. Then we
Mhm.
could finance the payments up to 12 months, as long as there's enough room with the future equity, et cetera, that we could finance it so there's no double housing expenses, which we're trying to avoid for the financial success of the home buyer.
Right.
Because if they've got to pay rent and pay the mortgage, their success is starting to get wobbly the first get go, right? So
Yeah.
they want to be able to have them live in something and not have to pay for the other place, so they could stay in their rental until the place is at least habitable
I love it. Oh
and
my gosh.
and finance that payment.
If you guys find this super valuable, again, I'll put Steve's contact information in the show notes. I encourage you to reach out to him and you can tell him that you've heard him on the Kristin Gutierrez podcast. But for real, I just think that with any I'm going to throw one last idea at you before we wrap up. It's like any idea, you can just say, "Hey, Steve, I have a scenario to run by you." So do you want to play that game right now, Steve?
Oh, the scenario game. Oh, it's my favorite game.
Okay,
It's my
okay, okay.
favorite part of my day is scenarios and solutions. So go, go, go.
So imagine that you own a home that's currently being rented out, but you want to move back into the home, right? So it's
Uh-huh.
your home you own. You want to, and the home, due to renters, but also really just the age of the home and all the work that needs to be done. Like it needs floors, ideally windows, a new AC, maybe some internal renovation. So I don't know. Like, let's just say it needs $200,000 worth of work, right? Or that's decidedly what the scope ends up being. So it's a home you already own
Hmm.
that the tenants are going to move out because you are going to move back in and you want to do $200,000.
Hmm.
Maybe that's a simple solution, but is that just a straight refi or is there another creative program?
Yeah.
Because
If Go ahead.
I was just going to say to conclude, like ideally, the parties already have another place to live and they already own the home. So they're not having to like rebuy the home, but they don't have the money to redo the home. Right.
Mhm.
So it's just kind of like they don't want to be in the home while the house is being renovated. They just want to get the renovation done so they can move their kids back into the house.
Got it.
What's it?
Got it. Yeah, no, I think that's all feasible. I think there should be a notice to vacate for the tenant. So
Oh, well, that's
lenders,
beside the point. Yeah. Yeah.
yeah, well, the relevance of it is the owner occupied versus non-owner occupied interest rates. So I'm always all about getting the interest rates the best that they possibly can and the most generous situation with how much to finance. So
Yeah.
these are available for investor borrowers, but I would want to ideally get them lined up into making sense as an applicant for an owner occupied. So
Okay.
we would
And
tell
it
us
would, yeah.
we're coming back, and then it's about the contractor, then it's about the future value, and then potentially financing those payments as well. Would want to understand where they're living now, motivation to move in, whatever. The stories matter. Stories matter.
Mhm.
So we'll want to tell the story. We don't want to omit the story. Tell the story about why they're moving back in to get that owner occupied interest rate. It's usually a 0.5% lower on the interest rate for owner occupied versus non owner. You could go up to 95% of the future value and owner occupied, 80% on non owner occupied. So whether either of those factors
Whoa,
matter,
95%?
yes, a future value. Yeah,
Is that
not
new?
even present.
Wasn't it lower before?
Hey, future value. Yeah, no, that it. Yeah, you could do up to 95% on conventional and even higher on FHA if FHA is the right fit. So
Wow.
we have FHA and non-FHA versions of this renovation loan. So I would look into whether it matters to tell the story because if to tell the story gets a 0.5% lower rate and 15% higher leveraging potential, then, we want to tell that story to get both of those benefits.
That's so cool. So, you guys listening, do you hear what he did? Like, I don't know. I'm just gonna assume most people would jump to be like, "Oh yeah, this is gonna be X, Y, or Z type loan." But instead, Steve kind of took a step back and said, "Well, that's a great scenario. And here are the other things we want to think about." And he also educated us in the meantime. So you provided lots of data points for us to think about tactics and strategies. But then you said the real thing that you do best is like, hold on, we have to, there's more questions we have. So you played my game phenomenally.
Yeah.
And but it's also like a really good, excellent demonstration of, you're gonna get in a private conversation, you would get to that the answer more quickly. And the reality is you quote unquote never really know because you do have to run the numbers. Every situation is different. And I think that's what I appreciate about your approach is you treat everything as a case by case, like you started off the show by saying, instead of a cookie cutter
Mhm.
solution.
That's right. People aren't cookie cutter. So, everybody's got their own life situation and goals. And, we try to come up with a custom fit, a custom strategy to give them a roadmap to home ownership.
Oh, what a great episode. What a great closing thought. Anything else as we wrap up and then we'll say adios and goodbye.
No, I'm good, Kristen.
Yeah. Okay. Thank you so much. You guys find Steve. We'll link him below. Tell him I sent you, or it doesn't matter. Just reach out to him and I hope that he can help you make your dreams come true. Thanks, Steve.
Thank you. Thanks for having me.